Hello, everybody. Welcome, welcome. I see that many of you guys are starting to file on in, whether you're joining us on YouTube, you're joining us on Facebook, LinkedIn, wherever you are. Welcome. So excited to be able to have you here. Oh, wait, maybe we don't have LinkedIn on here, but either way, we got you guys here. If you're watching the recording, welcome. I'm talking from the past, so welcome to the. I'm welcoming you from the future now. Anyways, excited to be able to get into this and really dive in. As we're starting to do that, there's always a delay with the comments and whatnot. So go ahead and type in just where you're from, your name. I see that Angela already said hello. Marco, good to see you as well. Cliff, hello as well. Good to see you guys joining in. Definitely really excited about this. We're talking about harvesting your savings, right? With infinite banking, this masterclass. And we I mentioned harvest because it's that time of year, right? Like we really want to be able to gather in the fruits of our labors. And most importantly, I want to make sure that I'm really talking to you, Marco from Texas. Hello as well. We're talking to you too, Marco, right? We really want to make sure that as we're talking about this is something that's not just a cool strategy for you because strategies are great, but this is something that actually can literally enhance and change your life, even shave off years towards your passive income goals if you want to, assuming you have passive income goals, assuming you want more time freedom, assuming you want to be able to have more freedom to be able to spend the time with those you love doing what you love. And so I'm going to talk about one specific strategy that works with what we talk about with passive investing that has been absolutely critical. In fact, it is literally helped hundreds of our clients do this very same thing. So again, welcome, Chris from Illinois. Welcome to see you. Good to see you as well. Good to see your name showing up with your state. It's good to see you that way. So, all right, I'm going to dive right in and make sure that we have this going here. All right. So, like I said, this how to harvest your savings tax-free with infinite banking. Now, I'm just going to warn you right now, I cannot see your comments or questions currently. However, as they come up, put them in the chat. We'll go ahead and address these and answer these towards the end here. So, I'm going to kind of go in. I'm going to address a lot of the commonly asked questions, but definitely, have your questions ready. Put them in because it will take about a minute or so for it to even show up on my side, on the live side. By the way, if you're watching the recording of this, feel free to put in comments or questions as well. I'll answer those afterwards too. So again, let's just dive right in. Like, what do we really mean by this? Well, if I can really show you how you can actually have your money storing in a place that's safer than the bank and definitely safer than the stock market, it's tax-free with guaranteed returns. So it's not just guaranteed at zero, like the bank pretty much is lately, but actually guaranteed at like 3+%. It's also protected from sue-happy predators and creditors, meaning if you get sued or if somebody even if they win, it's very possible that depending on which state you're in, most states in the United States, that you are safe. So big thing there. And also it's a passive income booster that will pay you twice, like I said, shaving off years towards your financial goals, allowing you to have more time freedom and more of your life back to do what you love with those that you love. Just like hundreds of my clients and I have already done the last few decades. If that's something you want to see, I would say keep watching because that's what we're going to talk about today. Now, this is not something that's brand new. This is not something that's revolutionary in the sense that it's something that hasn't been done before. You see here Walt Disney. If you've ever been to Disney World, you have seen evidence of this already working in people's lives. He actually used his life insurance policy, this cash-free this cash-free, this tax-free high returning savings account. He actually used as collateral along with selling one of his houses so that the bank would even give him the money to be able to buy the swampland in Florida that eventually became the happiest place on earth, right? So it's not just us. Walt Disney's been using it. If you've ever been to a McDonald's or seen the Golden Arches ever, not saying I would recommend eating there, but if you've ever been there, McDonald's, Ray Kroc used this money to be able to hire the executives to keep them on board after he bought out the McDonald's brothers. If you've ever used Pampered Chef, this is actually what they use for seed money to get Pampered Chef off the ground, turning it into a humongous business as well. I even had guys like Eddie Wilson, who's a mentor of mine. He's owned lots of businesses, sold them for hundreds of millions of dollars. His family actually taught him the strategy. His grandfather even taught him the strategy. His grandfather owned a bank and said, this is critical. You need to have this. And so many of the wealthy have also taught their children to do the same thing. And heck, even people that aren't born wealthy. I had clients on my podcast as well. This Jay and Krista Jorgensen. Well, Jay Jorgensen and Krista Hesby, they're married from Minnesota. With them, he's a dentist that was in his 50s. We actually were able to not just have him use a strategy because he was already using it, but we actually improved the strategy. So it saved him over $2.25 million in 20 years. Huge difference with no extra money out of pocket, was able to make an extra 2.25 million. The problem is most of these guys don't get it or don't want you to get it, because you got the Dave Ramsey's out there saying, don't do infinite banking. It's stupid. He tells you all that kind of stuff, right? He says, just do buy term and invest the difference, and put in the stock market, which makes 12%, which is never done. But he still tells you that. So you assume he's got to be right because he says with passion and confidence, right? But it's not. This is something that many financial advisors don't get. And just so you know, even good old Jake at State Farm, he doesn't get it either. So this is something that even most insurance agents don't get, because the insurance companies won't teach you to do this, because it'll actually help you make a lot more money minute you're really taking advantage of the system. Now, investors have been using this strategy, like I said, for many years. We even got people, I'll just tell you, like I've got people that have been using this like in real estate investing game. Even people that do stock trading look at this and say, whoa, this is a way I can get a little bit more leverage with my money, able to get my money to pay me twice. So it's something that really it's been used by investors and even by banks in many cases. Now, I'm going to say who this is not for, because I don't, if this is not something that's good for you, it's not, it's just not good. This is not a one size fits all. This is not something that's meant for everybody. For example, if you're not in the United States, I'm not going to recommend this, right? So I know that there's sometimes we get people on here from various countries. They'll say, hey, can I do this in Mexico? Or can I do this in Australia? And yes, they do have these kind of things. Even Canada, they have this. And you can do this in Canada, by the way, just not with us, right? So we can always connect you with people that can do it. But it's very different in different countries. They all have their own rules. So if you're from outside the United States, this is not something that we can help you with. If you are over the age of 70, this strategy we may not use. You may want to get something more for your estate planning purposes, but this strategy is going to be pretty expensive if you're in your 70s or 80s. Also, if you're overweight or in very bad health, right? Uninsurable that way, those kind of things, you'll get rejected or just get a really bad rating, and therefore it may not work. Also, if you're living paycheck to paycheck, you don't have two nickels rubbed together. This is where I would agree with Dave Ramsey in the sense that, yes, you should just get cheap term insurance. I would recommend, though, don't buy any term insurance. Buy what's called convertible term insurance. Buy it with the right company so you convert it to a good whole life policy with that same company. The cool thing is if you get a term policy that you can convert later on, good news is that, lo and behold, if anything were to happen to your health, even if it's bad, you can get more. Just so you know who this could be for, if you're able to save at least $5,000 to $10,000 a year as a max of savings, not saying that's the minimum, but the maximum. If you can save at least $5,000 or so a year, this could be a great strategy. Also, if you're looking for ways to save your money and get it to be safer than the bank and better returning than the bank and no taxes as well, this could be a great strategy. Even if you're in bad health, you can actually get a policy on family members. It might be your spouse, your children. You can get a policy on them, even a business partner. Get a policy on them if they're in better health. I did have a guy, he was a dentist, he was in his mid-50s, way overweight, very obese. He just said, Chris, even if I get approved, I can guarantee it's going to be super expensive. I said, well, you're married, right? Yeah. Well, how old's your wife? Oh, she's about 52. Okay, so she's younger and she's a woman, which means women live longer. They're cheaper anyways. And is she in good health? Oh, perfect health. I say, great. Well, we'll do the policy on her instead. You can finance it, you can fund it and everything, but we'll use her good health so that you get cheaper rate in that sense. You can get better return on this. And so he did. And he's been stuffing in over $100,000 a year, really for the last 6 years. So this is a great strategy to use if you're definitely putting away in any money into savings for that matter. And you're between the ages of roughly about 20 and 70. All right. Now, here's the challenge that we're dealing with right today. I mean, we got all kinds of market uncertainty right now. We've seen the stock market already lose about half of its gains that it made this year since July. So there's a lot of uncertainty there. We've got, the government that wants to step in there to help pay for their now $32 trillion in debt, right? And of course, where are they going to go? They're going to go for those typical places like your 401ks and IRAs where they can change the rules on you at any time to be able to attack your money, take those taxes out, and just really weasel it away from you. By the way, this is tax-free. It comes out tax-free. And if the government changes the rules, you get grandfathered into it. So even if they change the tax rules, you don't have to follow along. You're grandfathered into the old tax rules when you get this, whenever, because it's a contract. Also, banks, we already have the issue. I've had so many people say lately, hey, it's something doesn't smell right. Just to see a couple banks fail, and they're big banks, and then nobody else is talking about bank failures. That worries me. I wonder if it's actually worse than it really is. What if it's my bank that I'm banking with? That's a big concern. And so a lot of people are trusting banks less and less, not to mention FDIC, which is supposed to protect your money. Guess what? They only have about 1.5% saved up for you. So if 10% of banks fail, you're going to be waiting on your money for a while, even though you thought it was liquid. And if you need that money because you get laid off because we go into this depression or something like that, which is very possible, you're stuck, right? So there's all these things happening, and interest rates going through the roof, and we got inflation and everything else, right? Like all this stuff is getting to a head where we need to unbank ourselves. We need to get ourselves away from the banks, get the money in our control, where we can earn better returns, and we can avoid taxes too. By the way, just so you know, this is the perfect time to build more savings, to not invest. I mean, I'm not saying you don't invest, because we have plenty of clients that are investing, but even with our clients that are investing in passive investments right now, we're still telling them to build up that nest egg. And when I say the nest egg, I really mean like that rainy day fund, those emergency reserves, or even just an opportunity fund for future investments that come up as things hit the fan, right? Warren Buffett is already saving up more and more. He's now at 147 billion in cash. I expect actually to hear by next month in November that he's probably going to bump that up well over 150 million or 150 billion. Just so you know, end of 22 is 120 billion. So he's already gotten up of almost $30 billion just in the first 6 months of 2023. So that's a big thing. If he's saving up cash, and we got guys like the Kennedys, that's what they did before the Great Depression. They saved up a bunch of cash, and as a result, had money to be able to do the investments that took Joseph Kennedy, John F. Kennedy's father, from $4 million in net worth in 1929 to $100 million in net worth in 1935. This is the time to start harvesting your savings so that it works harder for you. So you don't have to work so hard for it to take advantage of things that most people will not be able to take advantage of. All right, so let's really dig into the strategy and what it is. Like, as you kind of notice, this is a life insurance type of product. Ironically, the most boring thing you could ever think of, whole life insurance, but not like your everyday normal whole life. This is not like your Nelson Nash become your own banker type whole life policies that really are more expensive than they should be. This is something much better. Now, I'll give you some backstory on me. Like those of you that know, I'm the anti-financial advisor, right? Well, I spent 4 years being the traditional financial advisor. Whenever somebody mentioned whole life to me, I said, don't ever do it. I would say the same thing that Dave Ramsey would say. I say, don't do it. It's a waste of money. It pays you nothing. It stinks. Go put your money in the stock market. You'll make more money there. Now, this is, of course, right around Y2K happens. And I quit right before the Great Depression, the Great Recession happened. But what was interesting is, as I started to learn of this whole other world of real estate investing and ways to actually create passive income, even to the point where by the summer of 2006, I was actually out of the rat race. I was able to retire when I was 28 years old because I had enough passive income to come in to pay my bills. And so I'm meeting all these real estate investors that are doing this stuff that taught me these things. And what was really kind of interesting is that they started talking about this infinite banking strategy. And I said, well, what is that? I've never heard of it. I was a financial advisor for 4 years. This doesn't sound familiar at all. They said, oh, it's using whole life insurance. I said, come on, that can't be the right thing. They said, no, check it out. It's awesome. And so I started, look into it. I drank the Kool-Aid. I went to the guy that they all recommended, and he said, hey, here it is. And I remember seeing the policy, and we were looking to put in about, $12,000 a year into it. And I said, well, this is pretty expensive up front. Are there ways I can manipulate it in a sense, just like I could do with other, universal life policies and things like that? Can I manipulate the numbers a little bit to where it's more cash heavy? And the guy told me, no, you can't. He's like, if you put in too much, it becomes taxable. You'll lose all your benefits. You might as well just get an IRA. I said, okay, well, I want to keep it tax free, so I'll just follow whatever you say. 2 years later, the recession's hitting me hard. I'm in the hole about $15,000 a month. So needless to say, I can't even afford to pay that premium, because even though I got to the point where I was able to retire with everything hitting the fan with real estate and a new business we had launched with a guy named Garrett Gunderson, everything was just going under. And so at that point, I had to finally just let my policy go because there was no cash in it to keep it going. And I couldn't keep paying $12,000 a year. So I just let it go. I lost about $25,000 I paid into it, gone. But it was like the most expensive waste of term policy that I could have gotten, right? I was insured for 2 years and lost 25 grand. And I was pretty upset, but I had bigger things to worry about, like getting my cash flow under control. Well, several months later, I'm talking with a friend who also bought a policy from the same guy. And he said, "Hey, did you know you could actually have cash in there from day one?" No, I didn't. And so this kind of let us start to play with things and start to pull different levers and tweak numbers. Because obviously, I still had a life insurance license from being a financial advisor. So I started doing my own research. I started doing my own things, playing with the numbers. And that's one of my gifts. I like to essentially build a better mousetrap. I like to break things, make it better. And I pretty soon I realized that that agent that sold me that policy lied. And so I went to him. I confronted him. I went to his office. I said, "Hey, listen, here's the deal. Um, you could have done this better." And he went back and forth about why you should do it this way or that. 2 hours we debated this. Yeah, even to the point it got pretty heated. Some people outside, like the receptionist outside this office, could hear us arguing. And finally, at the end of all of this, after I knocked down every one of his objections, he finally just told me, he said, "Chris, the reason I did it this way is because I couldn't afford to cut my commissions." And I said, "That is why you'll never get another referral from me again." And I didn't. By the way, he's no longer in the business. He now works for a bank. you know, and that's. And I'm not saying that I wished him ill will, but it's that kind of thing that ticked me off. In fact, years later, I mean, I started perfecting this over the really the last 15 years. Well, now, just even 6 years later, I found out even the guy that understood what I wanted the best ROI possible on these things, lowest cost to get the best return on these. Guess what? I found out he was still overcharging. That guy was overcharging. Not as bad as the first guy, but even just by a little bit. And that's when I said, you know what, enough's enough. I came out of retirement the second time because I was able to retire again in 2016. 2017, I'm pulled out of retirement by other investors saying, "Listen, you know how to do this. You know how to teach it. Can you help us do it for us?" And that's what I did. And so ever since then, our company's been designing these policies to get you the max ROI possible. That is what we really do. And that's why I call it no BS infinite banking, right? We give you the best numbers every single time, not trying to make what most people do in the infinite banking space. They'll say, "Well, you still get a good policy and I get paid more." The reason they don't do it is the same reason this guy said. They don't want to cut their commissions back that much. The truth is that if you actually do what's right for the client, they actually want to do more and you end up making more. So it ends up being a win-win for everybody. But again, that scarcity world, insurance agents, either they don't know about it, which is most of them anyways, or the few that do know about it, they're not willing to go far enough to give you the best numbers every single time. Or they'll do little tricks to say, like, they'll hide the numbers from you so you can't see the numbers unless you commit and do a policy and put some money in it. And then they'll say, "Here are the numbers," right? Bull. You guys should be able to see those numbers up front. It should be very transparent, not all hidden. People, even when they ask me, like, "How much money are you going to make on this?" If I even happen to know the answer, because I usually don't care, I can usually say it's probably around this much. Easy answer is whatever you have to pay in insurance costs. That's pretty much, we get paid a percentage of that in our policy, especially in that first year. So if you do a traditional whole life policy, you put in 20,000 and there's zero cash in there, that means they got paid a percentage of 20 grand. Or instead, it probably should be a percentage of like maybe 4 or 5 grand instead. So, all right. So here's how it works. Let me go into it. All right. Like I mentioned, it's tax-free, protected from lawsuits of creditors. In most states, it's 100% protected. You could have millions of dollars in here, and yet if somebody sues you, they cannot touch it. They can touch your savings accounts. They can even get to your IRAs. They can get to just about anything, but they cannot get to this. They can put a lien on your home equity, right? But they cannot get to this. That is one thing that is protected by law. It's also safer than the bank. The crazy thing is, even if the insurance company happens to go under, which they rarely do, the great thing is that they have what's called reinsurance that backs them up, that makes sure that these insurance companies that back up the insurance companies will step in and give you that money. I'll give you an example. The Great Depression, there were 35,000 banks when it started. At the end of the Great Depression, 13,000. 2/3 of banks failed. Insurance companies, 4 failed. That was it. So much safer than, in my opinion, than even FDIC insured banks. Guaranteed growth. Most of them are paying at least 5 or 6%. And good news, because interest rates have gone up, guess what's going to start happening next year and the year after? Their returns go up too. No stupid limits or penalties. You know how, like with Roth IRAs, you can only put in 6,000 or 7,000 a year. None of that here. You don't have those limits. Or even if you make too much money, they won't let you do that strategy, right? And none of this 59 and a half rule, where you can't touch that money or they slap you with a 10% penalty. There are no penalties like that. It's not a part of this thing. You can also get bank leverage. I'll talk about it here a little bit later. Protects your family, of course, because you got the death benefit. I didn't even mention much about that, but yes, it does help protect the family. Not to mention it's a good place to store cash. And like I said, the difference of what we do is you have access to cash today in that. So from day one, there's cash in there that you can use for emergencies or for opportunities. So here are ways to use this. Go along with that emergency fund or reserves. My wife, she said, Chris, I want to make sure we have $300,000 just sitting on the sidelines that does not get invested. We don't touch it. It's for emergencies. Well, do the math. I mean, if at my bank right now, they're still paying like 0.1% on my savings. If I keep $300,000 at 0.1%, I make $300 in a year, but then I pay taxes on $300, which means I'm left with about $200 at the end of the year. So I made a deal with her. I said, honey, and she was a Dave Ramsey teacher. So she was like, I thought whole life was bad. I said, here's what I'm going to do. We're going to earmark about $250,000 of this in our life insurance to be our cash reserves. The other 50,000 could be in the bank that we need to go walk into to get it today or tomorrow or something like that. But I can get to this other money, this other $250,000 in about a week from the insurance company. And she said, well, is it safe? I said, it's safer than keeping it in the bank and I'll make more money. Because guess what? If I'm making 5% tax-free on 250,000, that means I'm making 12,500 a year tax-free plus, the $50 or $40 or whatever from the bank. So really, I'm making well over $12,000 more than if I just let it sit in the bank. And again, it's tax-free. By the way, here's a key thing too. It kind of goes on with the kids' savings at the bottom. If I know this because I got 6 teenagers right now. If you're trying to get your kid to qualify for financial student aid with colleges to get the scholarships and whatnot based on financial need, they do not count this money against you. So this does not count as an asset. But if you ever try to get a mortgage, they'll count it as liquid savings that you can use as checking off that box of do you have enough in savings to get this mortgage. So it counts when you need it, but it doesn't count when you don't want it to count. Just like it doesn't count against the IRS because you don't report on taxes. So it's kind of cool. Cash flowing investments. We teach about this all the time. I'll even explain this a little bit more about how that works. But yes, you can actually get your money to pay you twice. You can use it as collateral. I had a client where he wanted to buy a building and he said, Chris, I've got this policy with $300,000 in it. I think I'm just going to cancel it, cash it out, and then use that money to go and buy my building. And I said, hold on, before you do that, just so you know, one, you can get taxed when you get rid of the insurance protection. You get taxed on the gains. So don't do that. 2, I bet you we can do something more creative with this. And so I told him, let's go to your local credit union and ask them, will they give you a loan on that building if you use this as collateral? Basically doing the same thing that Walt Disney did, right? With Disney World. I said, let's use this as extra collateral. So you have the building as collateral and you're using this as collateral. So they use that 300,000 collateral. They said, yes, all day long, we will use that as extra collateral and safety for us as the bank. As a result, they dropped the interest rate over 10% less than the going rate. Basically, it's actually similar. It was a similar rate to what we're seeing today. It dropped it down to like 3% on a building loan. 3%. His payment was only $1,800. He got extra money for the build out so he could go and rent out a unit. And after a year and a half, the renters were already paying for his cheap mortgage payment that he got. So a year and a half later, he went back to the bank. He says, listen, the building is all done. It's been built out. I've got a renter. Can we take the life insurance, lien against it? Can we take that off and free it up? And the bank said, you bet. And we'll keep the same terms, the same dirt cheap interest rate. We'll keep it for you. And that's what he got. So he got that 300,000 back again that he can go and use to invest and do whatever he want. But he just saved himself literally hundreds and hundreds of dollars a month and tens of thousands of interest that he would have been paying on that building. So a huge benefit there when you can use it as extra collateral. You can also pay off high interest loans. I wouldn't recommend paying off a house with this. Like some people talk about that. That's a myth. I think that's not very smart. Although rates are going up, maybe even paying for cars could make sense if the bank's trying to charge you 9% for a car loan. This might be better when the loans on, if you use this to be able to borrow against it to use it that way, most of these loans are between 5 and 6% right now. So they are pretty cheap. So you can pay off higher interest loans. You can pay off credit cards with this. And here's the cool thing. When you borrow from the life insurance company using this as collateral, so instead of using the bank, you use the insurance company's collateral. The cool thing is that they still pay you on all that money. And the great thing is there's no minimum monthly payment. So unlike getting a car loan or having a credit card payment, there are no payments. They'll charge you interest and it's dirt cheap, But you don't have to pay this back monthly if you don't want to. In fact, the deadline for paying it off is when you die, and they just take it out of your death benefit, pay your family the rest tax free. So that's kind of cool. Extra retirement income. That's what most people talk about with this. They say, hey, this supplemental retirement down the road, this could be your tax-free income. And you don't have to wait till you're 59 and a half. You could retire at 50, or 30 for that matter, and use this tax-free. I actually have one client that he's actually planning to use this in the year 2030 as part of his tax-free retirement. And then I mentioned kids savings. Most people are starting to get rid of their 529 plans, their college savings plans, because they're high risk. The market drops right before your kid goes to college. You could lose an entire year's worth of tuition almost overnight. So many people are saying, I hate my 529 college savings plan. Can I use this instead and invest wherever I want? And the answer is yes, you can. All right, so let's talk about that double dip, that double arbitrage. Now you might be asking, what is arbitrage, right? Arbitrage is simply this. And you'll see this whenever you walk into a bank. You know how you see like there's the little boards that are showing their little advertisements up there, the little TV screens up there, and then you'll see like this 60-month 5-year CD that says they'll pay you, let's say actually they won't pay you 5%, they'll pay you like 3% on that one. They'll pay you more on the short term. So let's just say it's paying you 3% on that CD. But then you see the other board and they'll show you, hey, you can get a car loan at 7%, right? You get it at 7%. That's arbitrage, because what they're saying is, put your money in the CD, lock it up for 5 years. We'll pay you 3% a year, but then we're going to take that same money and give it to somebody else to be able to buy a car at 7%. And guys, they don't just make 4%. They make over 100% return, because the interest they make is more than double what they pay you. So as a result, they're making, well, for lack of a better word, bank, aren't they? So they're already taking advantage of you in this sense. But what if you could turn the tables and put it in your favor? What if you can actually use their money in your favor to be able to make more money? That is arbitrage. If you can borrow at a lower rate and then make a higher rate of return, that's what I mean by arbitrage. So here's how it works. Now you can just put money into this policy, let it grow and compound tax-free, come out tax-free down the road. And that's a great strategy too. But here's what we like to recommend, because speed is everything. This is the reason why most of these policies that you try to buy out there today are just a waste of money, because they don't have that speed element. I'll give you an example. My dad just talked with me last night talking about his whole life policies that they bought like in 1973. He told me, he's like, man, it was decades before it paid for itself. Our policies pays for itself by the 3rd or 4th year, not decades. So it's already like free insurance by that point. I told him about it. It blew his mind that was even possible. So here's how you can use it though, to make greater speed so that you can actually shave off years and create more freedom, and especially not just financial freedom, but ultimately more time freedom to do the things that you love and spend time with those that you love. So here's what it is. Money goes into the policy. You see the money goes in. Now, here's what it happens. That policy earns dividends, right? It's earning tax-free returns. Like I said, pretty darn close now. They're getting up there to about 6%. I think starting about next year or so, you'll see a lot of them paying over 6% a year tax-free. That might even be better than what the stock market can provide in the next decade, I think, especially if interest rates stay higher. So they're paying you dividends on this money. But instead of just pulling the money out, withdrawing the money, because most people, they just go to the bank, they put their money in savings, and when they're ready to invest, they withdraw the money from their savings account and invest it. So yes, they make money on the investment, but their savings account's been dwindled down to almost nothing, and therefore they make no interest anymore, do they? But what if you could still keep the money in that savings account, still earning interest, and still invest the money? So it's essentially working in two places at the same time. That's what you do with life insurance. You have the money inside the life insurance policy where it's earning that 5 plus 6% tax-free dividends, but you get a line of credit against it. Now, yes, they'll charge you between 5 or 6%. And some people say, well, I'm breaking even. Well, I'll explain why. Even if you were paying a higher interest rate to them, you could actually make more money still. But you take that money out, you borrow it from the insurance company, you go and invest that money. So you're investing the insurance company's money while your money's still in there, earning those tax-free returns from the insurance company. So you're borrowing from the insurance company, like a line of credit from them. You go and invest it, and then you take the cash flow and you use that instead of just paying back into a savings account, right? Take the cash flow and pay it back towards that insurance company's line of credit. So you're using that money to kind of go back in. Almost like if you got a home equity line of credit, you cashed it out and invested it, then you take the cash flow from that and use it to pay back towards that line of credit. Same thing. So you're taking the cash flow, using that to pay towards a line of credit. What that does is it starts whittling down the balance of that loan, meaning you pay less and less interest. That's, by the way, that's how you actually beat with your compounding interest, because your compounding interest goes like this as time goes on. If you've ever seen those curves of compounding interest, right? It gets more and more and more each year as the balance goes up. But if you're using the cash flow from the investment to pay down the loan, the interest you pay goes down, down, down. So what happens is, especially even if it's right around the same return, you end up making more money. Let me give you an example. And here's another way to view it. If you want to see it more visually, I'm going to give a kudos to Danielle on my team, my chief marketing officer, for helping create this, because I just drew it out, but I'm an ugly drawer, just so you know. Some people are, some people have ugly pictures. I'm an ugly drawer, right? So same thing, right? You got your cash value policy. That's the cash in there. This is not the death benefit. This is the cash, the savings account in there. Get a loan from it. You get, like, say, $30,000. You purchase that investment. Let's say that investment makes you $3,000 a year. That cash flow is what you use to pay down that line of credit. Same thing. All in the meanwhile, you're still earning tax-free interest. So you're earning a net interest. Maybe it's only like 1-2%. But if you're making like that 10%, what happens? You go from a 10% investment to adding an extra 1 or 2% or more. And now you're making 11 or 12% interest instead of just that same 10, because your money's working at two places at the same time. So I'll give you an example. Here's the difference. If you want to see how a savings account works versus using this, it's drastic. So let's just say you want to buy a small apartment building. The down payment's $250,000, not a cheap one, but I wanted you to kind of see how this works. Let's just say that the net cash flow from this property is $2,500 a month. So that's $30,000 a year you're getting back. Now, if you pulled that money out of a savings account and you dropped it into that apartment building, right? Now you're going to start building that up $2,500 a month in your savings account again, earning point nothing percent while you get taxed on it. And you start building it up. So over 9 years, you put in $270,000. But guess what? Even though you did that over 9 years, $270,000 only made you $1,200 of interest. But what if I use my life insurance policy instead, where my money's still in there? The $250,000 still stays there, earning tax-free interest at a much higher return than point nothing percent. But I'm able to get a line of credit against it and then use the cash flow to pay back that line of credit. What happens after 9 years? Here's the difference. Almost $127,000. Guys, that's 100 times more in interest over 9 years doing that. This is just not just by numbers, guys. That really the extra 125,000 plus that you're getting, that's freedom for you, because that's money that could be then used to be able to create more passive income. And like I said, could shave even more years off, because what if that 125,000 could generate another $1,000 a month for you? That's just getting you closer and closer to your goals faster. All because you just got your money to work a little bit harder. But that little bit means a lot, doesn't it? That's how you make money twice. I love this meme. Thanks, Danielle. I got a fever and the only prescription is more arbitrage, right? That's why we want to do this way. Yes, you can withdraw from your life insurance cash value, that tax-free savings account. You can withdraw from it just like a savings account. But my clients and I, we don't want to, because we know we can still get paid on all that money while we're paying interest. But by using this method, we actually make more in interest than what we have to pay them. And we could still invest it to make interest there too, right? So we're now making money in two places. Now, many people say, well, how's this compared with like other infinite banking? Well, I had one of my clients, Tony, reached out. He said, hey, I've got this policy. What do you think? And so his policy, the one he had, was the one on the left. Notice that, with the way they had it, they actually had a cash coming out because he had a loan outstanding on it. It was $19,513 a year that he was paying into it, even though the minimum was supposed to be $8,200. Well, I said, let's do apples to apples. So we said, let's move over your money tax-free, move it into this place, and let's see what happens. Notice by age 70, we got $535,000 on the right-hand side. That's our policy versus his at age 70. You'll notice that he's got about $419,000. The crazy thing is, it's the same company. It's using a very similar, well, I should say the same one. It's a similar company. Like, they do the same kind of strategy. They were doing infinite banking, but it's just done better. So we're able to move that money over. And look, that's over $100,000 difference in just roughly about 20, not even 20 years, about a little over 15 years. Same dollar for dollar, just doing it better. Why? Because we can lower our costs. We get them as low as we possibly can go before we break it, before it all of a sudden starts taxing you. So we keep it as low, get as low as cost as low as we can go while still keeping it tax-free for you. That's huge. Now, some people ask, what about index universal life? I actually just had this question from somebody that wanted to watch this today, and she knew she wasn't going to be able to be on, so she's going to watch the recording. Well, I'll address that. Why not an index universal life? Because there's a lot of people pitching those lately. Well, one, in 99% of the cases, there is no double dipping. And even when they do have the double dipping ability, still, they're usually not very good. So they don't allow you to be able to make money in two places at once. They do like what's called a wash loan. So they just give you a 0% loan versus saying, hey, we'll let your money still grow and you can still manipulate the system and make more money in it, right? They won't let you do that. Also, one big thing with all universal life policies is that costs go up every single year. It's the opposite of whole life, where costs actually go down after the first few years. The first 2 years are the most expensive, which we try to reduce as much as we can. And then that's why by the year 3 or 4, it's paying for itself. Index universal life, usually when you get in your later years, it's not paying for itself anymore. In fact, it's actually eating itself alive. So if you try to pull money out and it's eating itself because the insurance costs are so high, not a good thing. And ultimately, this is the one reason that I stopped using them, because I actually used to use these back in the day, 20 years ago, before they got popular, is that there's just no certainty. You don't know what the stock market is going to do. Most of them are based on just speculation of, well, here's what the market could do. And this is assuming we don't lower our returns on you so that, things you have no control over. It's hard to predict because there's so many different moving parts. Give you an example, even when they do predict that they can make good money in it, I showed this example right here, 12,000 a year, $1,000 a month going into one policy on the left-hand side. That's the IUL, right? That's going in. Notice at year 27, there's $537,000. And that's if it gets good market returns. If it doesn't, not so much. But on the right-hand side, look over here, same thing, age 67. Actually, I stopped at age 66. All of a sudden, $591,000. So it's already got like $60,000 more. Actually, and really, if you go by that, $495,000 age 66 versus really, there's about $100,000 difference in that. So even when they have a decent design policy, we still kick the crap out of them anyways. And there's more certainty around it. I have some investors here, like one of my clients, Neil. I asked him, I was like, why do you do this? He says, I don't want, one, risk and exposure to banks. And two, I don't want to get sued. I want to protect my money, have millions of dollars that nobody can touch. One of my other friends, Ron, he actually owns a great turnkey real estate company. He said, man, I was asking this of all these investors that are mastermind. Everybody was saying, keep it in the bank. But he's like, I remembered, especially when I made mention of it in that meeting. I said, well, listen, buddy, you already have one. And he bought an infinite banking policy that sucked, bought a better one for me. And actually has 2 of these policies now. But he remembered the same thing I mentioned earlier, that very few insurance companies have ever gone under over the many years. By the way, some of the companies we use have not only been certain, like they've not lost money over the last really century plus, 100 years plus, but they've actually always at least paid their minimum returns. One company we use, in fact, has gone just over 175 years, pre-Civil War, that they've always paid interest on through depressions, recessions, wars, and world wars. You name it, they have always paid. That is something you just do not see in the world today. So not to mention, he mentioned lawsuits was a big thing. Now, if you're watching this right now, you can actually scan this barcode if you want to see what the numbers look like for you, because that's always the question. Someone's like, well, what can I do? How can I see this work for me in my life? How can we customize it? That's the great thing. We design these to fit you. So great way to do that. Scan this. Go ahead and scan this barcode. If you can't do that, you can always go to moneyripples.com, shoot us a message, and we'll connect you as well. But go ahead and scan the barcode. This will take you right to the calendar for our team to be able to set up a meeting with you. And so great way to do that, just so you can see what it looks like. Again, no BS, no big commitment. Just if you want to see what it looks like, great way to do it. Now, here's what I ask. If you're going to book this meeting, don't be a hoser. Don't be like another life insurance agent that just wants to see how we do it. If you want to know how we do it, talk to me first, okay? Don't waste my team's time saying like, hey, I'm going to try to figure out how you do it, but I really don't want to do anything. I'm just going to waste your time and take it away from somebody else that actually wants this now. Just so you know, time is of the essence, because every year you get older, the more expensive it gets. So if you want the better return, I mean, obviously 20 years ago would have been the best time to do it. We hear that all the time from people. It's, oh, where were you 10, 20 years ago? Oh, well, 10 plus years ago, I was recovering from the last recession is what I was doing. But 20 years ago, I was a financial advisor. You wouldn't want to talk to me anyways. But people are like, where was this? Like, I want to know it. Well, yes, 10, 20 years ago would have been great. But right now is the only thing you can control. And right now is the best time, especially if you have a birthday coming up. You want to make sure you're getting this done soon. At least get the application in. If you get it in before your birthday, they'll lock in the date so that you can still get the cheaper costs. So anyways, you can scan that code to run numbers with our team here. So that's the big thing, guys, is that I don't want you to be in a place where banks go under. I really believe we're going to go into a very deep recession still. Even today, they're telling us, holy cow, the economy is stronger than we thought. How is that possible? Government spending makes that possible because they throw that into the numbers too. It doesn't mean our economy is stronger. It just means that we're spending a lot of freaking money. Eventually, that has to come back into balance. Really, the bigger the party, the bigger the hangover. And we've had a big freaking party for the last 3 years, especially that the hangover is overdue. So I want you to make sure you have your money safe and you're ready so that you can get that money working harder for you when you get it out to invest in better things than just putting it in the crappy stock market, things like that. All right. So go ahead and start putting in any questions you guys have. If you haven't put them in already, go ahead and put those in. I'm going to start going to that right now as I switch off of this screen mode. There we go. Let's go ahead and dive into these questions. So, all right. Okay. So let me go back here. There's a few questions I see here. So, all right, Michelle. Let's see. Oh, thank you. So Michelle says, do these policies include long-term care riders? Great question. Some do, yes. Some companies do. One company that we use, we don't put a long-term care rider per se, like that doesn't call long-term care, but they have what's called chronic illness rider, which just means that if you're pretty much disabled, you can't do at least 2 of the normal daily functions, much like the disability type of qualification, you can't access up to like 25% of the death benefit. Also, if you happen to have a, heaven forbid, a terminal illness where you might pass away in the next 12 months, you can actually get access to 50% of the death benefit early while you're alive. So there are some living benefits. I'll tell you this, some people ask, like, should we put this disability waiver on this so that I don't have to pay premiums if I become disabled? For the most part, most of our clients don't. For the very reason I mentioned earlier, this policy starts paying for itself by year 3 or 4. Give you an example. I had a guy that he just said, Chris, I just want to put in 100,000 a year for 4 years and then stop. Now, the minimum you got to pay into these things are 7 years, even if it's just the minimum payment. I said, well, the only way to get around that, having to pay the extra 3 years on that, is to just borrow from the cash to pay the premium. But the good news is, after that 4th year, guess what? It's already paying for itself anyways. So this guy, he's put in 100,000 a year for 4 years. He got the cash that he had in that account up to about 380,000. But by the time he got to the 7th year, he just borrowed from that 380,000 to pay the next year's premium, pay the next year's premium, pay the next year's premium. He got to that 7 years. Guess what? There's about $420,000 in there. So even though he only put in 400,000, there's 380 when he started. It ends with 420. It grew by about 35 to 40,000 more, even though he didn't pay a dime into it. So our policies pay for themselves so quickly. Most people don't even worry about that because they have access to most of that cash right away. And that's really what most of those long-term care riders do, is they have you access the actual cash, which you can do anyways. So you're just paying extra for a rider that doesn't really give you a lot of benefit, at least not with the way we design it. So great question, Michelle. I'm glad you brought that up. There's another question here. Let's see. Dave, yes. Oops. There we go. Dave, it says, what if you overfund an IUL? Will the cost of insurance go down? Yes and no. The costs don't go down per se. They actually do go up a little bit, but they do perform a little bit better. What I just showed you there, that screenshot I showed you with the IUL, that was an overfunded IUL. And we still beat it when we overfund our whole life. And we beat it with a lot more certainty. So very rarely will I see an IUL. I remember one guy, an agent, actually sent me numbers that there's beat it, but it was based on a pretty high rate of return that I wouldn't ever feel comfortable telling my clients that they could get that. So could you get it? Yes, but probably not. Not to mention, here's the other thing I didn't mention about index universal life, or any universal life policies for that matter, even variable universal life or simple universal life. The problem is that they also have surrender fees. So they limit access to that cash early on. Where with whole life, there are no surrender charges, surrender fees, nothing like that. If you guys ever had annuity, they tell you, hey, we'll give you this bonus, but you got to leave it in here for 10 years or you don't get it. And we'll even charge you more too if you try to pull it out too early. There's nothing like that in the whole life at all. So it's very, very simple. Whatever the money is in there is yours. That's the good news there. Tim asked, he says, oops, sorry, we're both hitting the numbers or hitting the button at the same time. If I needed to, for whatever reason, could I close or end my policy? And the answer is, Tim, yes. To go along with that very same question, yes, you could. You could close the policy or end it. Here's what I tell most of my clients though, and I've had a few clients ask this lately as things have gotten tighter in the economy. I know they keep saying the economy is robust and the consumer's resilient, but being on the front lines and hearing people's concerns right now, there's a lot of people that are starting to get strapped for cash more and more. Here's the good news. And let me just give you an example of one ways we design it. When we design it, like let's just say you want to make the maximum per year that you put in $10,000 a year. The minimum required premium on that 10,000, again, this depends on your age and your health. But let's just say that go along with this. Usually at a 10,000 max per year, the minimum is going to be about 2 or 3,000 a year. So you're only required to put in 2 or 3,000 bucks. So the question, of course, somebody would say is, well, what if I can't pay 10,000 that year? Well, great. You don't have to. It's totally optional. Think of it almost like paying extra principal on your mortgage payment, right? Like you get your minimum mortgage payment, but then they put in a little extra category saying, do you want to add more in principal, which the banks love, by the way. You could throw that extra on there. Same thing with life insurance. That minimum is only about 2 or 3,000 bucks. That's all they care about. The extra money you're putting in, or as Tim just said, or not Tim, sorry, Dave said, it was about overfunding. That amount is optional. So and that's not always true with every company. Just so you know, some companies do make you pay that in, but we use companies where you have more flexibility. So when I had somebody reach out to me and said, Chris, I don't know if I can keep this policy. Do I need to close it down? And I looked at his policy. One, he had it for the last 4 years. And he had a decent amount of cash in there. So he didn't like strip all the cash out of it. And I told him, I said, well, you could, and yeah, you'll get, most of the money you've paid into it back if you do it that way, but I said, you have options. So here's your worst case. Worst case is you pay the minimum. Can you pay the minimum? He said, I'm not so sure. I might be able to pay it eventually, but not right now. I said, fine. Well, guess what? You got enough cash in here. You can actually use the cash to pay that minimum. Just like the guy want to put in 100,000 for 4 years and then borrow from it for the next 3. I said, just do that. And you'll be surprised. The cash will actually keep growing based on where you're at right now. And so I'm like, it's really just like taking money out of savings to put it back in savings is what it's like doing. And so he said, all right, let's do it. And so I went, emailed the insurance company, said, hey, he's going to need to, actually, as of a couple of days ago, need to have this premium taken out as a loan to be able to pay that minimum premium. And they did. That's that. No issue, no consequence. And like I said, the loans that you get from the insurance company, the deadline for paying those back or paying anything at all is your death. Now, if you don't pay anything on that loan, it does accumulate interest, right? Kind of like, just like if you had a student loan in deferral. But the great thing is you don't have to pay it back. You have the option to pay it if you want to or not. So anyways, the worst case is you just borrow from the cash to pay the premium. That's the thing I couldn't do with my policy. Remember when I wasted 25 grand? They made it so cost heavy in the beginning that by the 3rd year, I had a couple $100 in it. That was it. Out of 25 grand, there was a couple $100. And in 1 month, gone. All because they made it more expensive. So we really try to make it to where very, very rarely does somebody ever close it or end it. But yes, Tim, you could. Oh, here's the good news. Like I said before, you're only required to pay the minimum, and you're only required to pay that for 7 years. So even after 7 years, if you decide you don't want to keep paying into it, then stop. It's going to keep growing tax-free anyways. We'll make it what's called a paid-up policy, and it keeps going forever. That's what my dad said he had to wait decades for. You can literally do that after 7 years. Many people might want to keep putting money into it because they know that they keep putting more money and it's going to grow faster and faster anyways. And they can just always pull it back out once they put it in. So many people will keep paying into it, but you do have that option and you don't have to decide up front. So you can really have that flexibility to decide as the situations change. And so that's what I love about it, is that it's so flexible. It works with you and your life circumstances so easily that it's awesome. It's great. All right. Other questions? Any other questions from you guys here right now? I know several more of you have jumped on. Dave asked another popular question. Do you recommend the 10-90 policy or the 90%, cash going in, 10% of the costs, or the 60-40 policy for whole life? These are both strategies that we could do. And I'll be very blunt, Dave. The 90-10 strategy, Mass Mutual is the one that does that. We are appointed with Mass Mutual to do that kind of strategy. That strategy is more expensive than about the 80-20 or 75-25 type of blend that we do with like other companies. So the 90-10 is actually a kind of a smokescreen. In fact, even with Mass Mutual, they have another product that you pay in it has about 25% coming out that first year, 75% goes in cash. That one will actually beat the 90-10 policy by year 5. So the 90-10 policy, yes, they make it cheaper in the first year, but they make it more expensive later. So the real key to design, and this is what's taken us years to kind of find the right blend, is to figure out how to get it to pay you more now and later. And just so you know, that 60/40 policy is the very one that other infinite bankers do. The only reason they recommend 60/40 is because it pays them more money. You are literally paying almost double the cost that you should be in those policies. I have a friend that teaches this, and he's done a lot of YouTube videos on it. That 60/40 blend is not better for you. Not once has his numbers ever beat ours when we do it with more of a 20 to 25% cost coming out versus the 40% of cost coming out. So I'm glad you asked that, Dave, because that's the one thing that, again, we beat their numbers every freaking time, no matter what they say. Oh, it's better. No, it's better for the agent because they make about double the commissions. That's why it's better for them. But that takes away from you. And that's not cool with me. That to me is kind of borderline white lie, which is really just a lie. Great question. Any other questions from you guys? Right. Anyways, guys, this has been great. I really appreciate it. If you have other questions, of course, you can put them in the chat or the comments on YouTube or Facebook or wherever you're watching this right now. We can go ahead and address those questions. Of course, if you want to see how this works, like I said, go ahead and reach out. I know we put up the link here earlier. I'll put that right here. Oops. Wait, I didn't hit the link right. Try again. There it is. So there's the link right there. You see that? That's actually in the notes there, both on YouTube as well as in the comments of Facebook. You can book it right there if you couldn't scan the QR code. But of course, we love to be able to serve you in any way possible. And if it's not a good fit, we'll be honest. We'll let you know. If it's something that's not good, even if you have another policy, maybe you have another infinite banking policy you've been using, you're wondering if it's really good. Hey, that's what that couple did, where it saved them 2.25 million. Same thing happened for them. That was what happened with them. And I actually wasn't going to analyze it first. I said, it's probably good. You've had it for several years. They said, well, can you check anyways? We did. And that's that. I'm so glad that they asked us to do that, because it's a little bit extra work on our end to try to help you try to change over. But if it makes sense, we'll let you know. If it doesn't, we'll definitely let you know and say, you know what, keep it the way it is. Maybe don't throw more money into it, but you can just keep it the way it is. And we can give you some good guidance on what to do with your current policy as well. But anyways, we want to make sure we do the best thing for you guys. Go ahead and reach out to us, schedule a meeting with our team, and see how you can actually really get this money working harder for you. So then you later on don't have to work so hard for this money. Guys, make it a great day. We'll see you later.